Hello, I'm Mark Patton. In this educational video, I'm going to tell you a short story about a cow's life. And of course, this story is just to get your attention, but it draws some analogies between a cow's life and some risks that investors face during long bull markets like we've experienced. So I hope that you find this helpful and educational. Before we get started, I would like to point out there's some important disclosure information you can access via our website at any point in time. You can simply roll your mouse over About Patton and click on Disclosure and access this content. There's a lot of performance information in this particular presentation. All the information is designed to be representative of these various portfolios I'm going to share with you. But for more details, please take a look at our disclosure. With that, let's start with the big question. Why do we diversify our portfolio? During bull markets like we've had, we start to ask this question more because the bull market has lasted so long and diversification sometimes doesn't look like it's adding much value. So we need to be reminded sometimes of the long-term value of diversification. So take a look at these numbers here. I've got four different portfolios we're going to talk about during this presentation. The three portfolios on the left are diversified portfolios. On the right-hand side, it's 100% U.S. stocks, but it is diversified between large, mid, and small stocks. So on the left-hand side, we have what we call a traditional growth portfolio. That's a 70% stocks, 30% bonds portfolio, very traditional growth-oriented portfolio, predominantly U.S. stocks, some international stocks, and bonds. This better diversified portfolio, what we call a better diversified portfolio, does include U.S. stocks, but also a meaningful allocation to international stocks, plus it has commodities, gold, real estate, and some other asset classes in it to provide more diversification. That is proven to add value over time. The next one is our super diversified portfolio, very much like the better diversified portfolio, but it also includes an allocation to our proprietary long-short strategy we call the Patton Flex strategy. A lot of information on our website about that if you're interested. And then on the far right-hand side, again, is a much less diversified portfolio, 100% in U.S. stocks, one-third in large stocks, one-third in mid-sized stocks, and one-third in small stocks. Let's take a look at the performance of these four different portfolios during various types of market environments, particularly bull markets and bear markets. So here you can see the most recent bull market starting in February of 2009, coming out of the 08-09 financial crisis that we had. This most recent bull market started in February of 2009. It's been a long bull market. It's been a very strong bull market. And as you can see on the right-hand side, this all U.S. stock portfolio has done extremely well, compounding annually at 16% compounded annually over this window of time. It's been a very strong window of time. And you can see these diversified portfolios have actually lagged behind, during this most recent bull market. That can be very frustrating for investors, and we start to lose focus, of the purpose of diversification, especially during such a long bull market. I want to remind us of the value of diversification during these windows, during full windows of time of bull and bear markets. So let's take a quick look at the story of a cow's life. If I could blow this picture up, I would if I could do so easily, but it's really a beautiful picture. It's a picture of a mama cow and a baby cow. And you think about a cow's life, over the course of time going across the bottom here. The cow, as time passes, becomes happier and more complacent as time passes. You think about this, the cow is put out to a beautiful pasture, has beautiful green grass to both eat and roam around, is fed other food as well, has people caring for it. It's beautiful weather a lot of the time. So this cow's life, is a pretty good thing. And over time, the cow simply becomes happier and more complacent as time passes. And I believe that's often what happens with investors during long bull markets. Now, the challenge is we know how this cow's life, ends. It's a tough ending for the cow. Now, the good news for investors is it doesn't end the same way. It's not this dramatic. But for the cow, it's pretty dramatic, of course. It's a very tough ending for investors. After long bull markets, when we do finally go into a bear market, it can be a relatively tough ending as well. And we want to make sure that we do everything we can to help mitigate some of that risk. So the reminder here, fact is that a long bull market like we've had, causes investor complacency, and investors begin to ignore risk, leaving them exposed to potential massive losses in the next bear market. Now, I'm not predicting a bear market, and I'm not guaranteeing predicting when will happen, but if we have history as an indication, I believe bear markets will likely repeat at some point in time, and we want to be prepared for that. So, a reminder again, over a long window of time, this 45-year window of time, U.S. stocks have done very, very well. But you'll see diversification actually adds value over longer windows of time. So a diversified portfolio actually performs better than an all stock portfolio. During bull markets, not necessarily. During full periods of time of bull and bear markets and longer windows of time, you can see history has certainly suggested that is the case. Let's take a look at some bull markets and then the tough endings that have occurred. An early bull market that from our research goes from 70 to 72, a pretty good bull market there. You can see this one ended very roughly. The bear market of 73, 74 was almost a 2-year window of time. And take a look at the performance of these portfolios. That all stock portfolio fell nearly 50% during this particular bear market. It was rough. These diversified portfolios, they lost money, but not nearly as much. They dramatically reduced the risk of some loss during this particular fairly tough bear market, as you can see. Let's take a look at another one. This is a great bull market of the early 80s from 82 to 87. It was a great run. Some of you might remember how this one ends, at least temporarily. It was a crash in 1987. It lasted about 3 months. There was obviously one day that was the crash, but there were some losses that took place around that as well. During that short window of time, an all U.S. stock portfolio lost 32% of its value. Again, a tough, very short window of time. You can see these diversified portfolios dramatically reduce the risk of loss again. You're going to experience losses in a diversified portfolio, but we don't expect them to be nearly like being in an all-stock portfolio. Let's take a look at another one. The bull market of the late 90s, a phenomenal run in the stock market. Great time for U.S. investors in U.S. stocks, and you'll see this one ended in a very rough ending as well. This is what they call the tech wreck of 2000 to 2002. Actually, the NASDAQ composite lost nearly 80% of its value. Good news is that an all U.S. stock portfolio diversified between large, mid, and small lost 37% of its value. That's a pretty rough bear market. You can see a diversified portfolio did phenomenally better during this particular bear market. This is a reminder that all bull markets are not the same and all bear markets are not the same. We can't predict what the next one will look like, but you'll see consistency here that these diversified portfolios did a tremendous job, at least historically in these bear markets, of dramatically reducing the risk of loss during bear markets. Let's take a look at one more. Another great run from 2002 to 2007. U.S. stocks did very well. This one ended in a very rough ending. The financial crisis of 2008, 2009. You'll see that all U.S. stock portfolio lost 53% of its value, and these diversified portfolios again helped mitigate a meaningful amount of risk, but not as much as during some other bear markets. There were some pretty significant losses here, but again, relative to an all-stock portfolio, meaningfully reduced that risk during the bear market. So again, you'll see consistency across this data that historically these diversified portfolios have significantly and meaningfully reduced risk during bear markets while also delivering better long-term returns over longer windows of time than simply being in stocks. I know that during these bull markets like we've had here on the screen from starting in 2009, I know during these times we look at the U.S. stock market and we wonder why we diversify. Hopefully this is a reminder of why we diversify and a reminder that over longer windows of time we expect that a diversified portfolio is going to deliver to investors better long-term rates of returns. With that, a few reminders. Number one, we cannot predict when a bull or bear market will occur, and furthermore, we have to remember that they're all different. Every bull market is different than the last one, and bear markets are different, but you did see consistency in this data that diversification helped. Number two, don't let the long bull market make you complacent and ignore risk. It's very hazardous. And number three, stay diversified to position yourself for the best long-term returns. I encourage every investor to do that. Everything that I know about investing, diversification is the way to produce the best long-term returns and help mitigate some of that risk during the rougher times. If you're interested in getting my market commentary, I do post a blog on a weekly basis on our website. You can go to pattonfunds.com, click on blog, and access not only our weekly commentary, but some other blog content as well. You can sign up for our email notification when we post blogs on our website as well. And then last is that anytime you have any questions at all, anytime I can be of service to you in any way, our phone number is here, my email address is here, and you can always go out to our website and simply click on Ask Patton, and it'll take you to a page that you can send me an email directly from the site. Again, there's some important disclosure information on our website I encourage you to take a look at, given all the performance information that we shared here. If you've got any questions, if I can be of any service to you, let me know. But again, the message here is stay diversified. It's the best long-term investment strategy that I'm aware of. Take care and thanks a lot.